Today we'll talk about the comparison of the pros and cons of quantitative easing and zero interest rate policy during the 2008 financial crisis and the current crisis. Welcome to my channel, where we bring you the latest insights and perspectives on investing and financial knowledge from around the world. What are the consequences for banks of not raising deposit rates in a scenario where savers can earn higher interest rates on money market funds, leading to a significant outflow of deposits from the banking system? It is possible that a massive mortgage and bond portfolio purchased during a zero interest rate period could become a problem if the Federal Reserve were to raise rates too quickly. This could cause depositors to flee if banks don't raise their deposit rates to keep up with the competition. If savers can earn higher interest rates on money market funds, they may choose to move their money from bank accounts to these funds. This could lead to a deposit outflow from the banking system, which could have negative consequences for banks that rely on deposits to fund their lending activities. However, it is important to note that the Federal Reserve typically raises interest rates gradually, giving banks time to adjust their deposit rates and avoid a sudden deposit outflow. Additionally, banks may choose to raise their deposit rates to compete with money market funds and retain their customers. Can you explain the potential reasons for bank failure if they make risky investments or engage in fraudulent practices? If the scenario you described were to occur, and there was a massive outflow of deposits from the banking system, it could put some banks at risk of failure. The reasons for bank failure can be complex, but some potential factors that could contribute to it in this scenario include asset-liability mismatch. If banks have a large portfolio of long-term fixed-rate mortgages or bonds but need to pay higher interest rates to retain deposits, their net interest margin could shrink. This could lead to a mismatch between their assets and liabilities, which could increase their risk of insolvency. Funding liquidity risk. Banks rely on deposits to fund their lending activities, so if there is a sudden and significant outflow of deposits, they may struggle to meet their funding obligations. This could lead to a liquidity crisis and ultimately result in a bank failure. Credit risk. If banks have a large exposure to a particular sector or borrower group that is adversely affected by rising interest rates, they may experience higher levels of default and credit losses. This could erode their capital position and increase the risk of failure. Operational risk. Banks may face operational challenges in managing a large deposit outflow, such as disruptions to their payment systems or difficulties in maintaining adequate staffing levels. Regulatory compliance risk. Regulatory compliance failures, such as inadequate risk management or capital planning, could increase the risk of bank failure. How will an increase in interest rates by the Federal Reserve affect the profitability and operations of banks? If the Federal Reserve keeps raising interest rates, it could have both positive and negative effects on banks. Here are some potential ways that rising interest rates could impact banks. Positive effects. Increased net interest income. Banks earn a significant portion of their revenue from the net interest margin, which is the difference between the interest earned on loans and the interest paid on deposits. As interest rates rise, banks can earn higher interest income on loans while keeping deposit rates low, which can increase their net interest margin and profitability. Improved loan quality. Higher interest rates can make it more expensive for borrowers to take out loans, which can lead to fewer loan defaults and improve loan quality for banks. Negative effects. Decreased demand for loans. Higher interest rates can make borrowing more expensive for consumers and businesses, which can lead to decreased demand for loans. This can result in lower loan volumes and lower revenue for banks. Increased funding costs. Banks rely on deposits to fund their lending activities, and rising interest rates can increase their funding costs. If banks do not raise their deposit rates to keep up with the competition, they may face increased funding costs and lower profitability. Asset-liability mismatch. As interest rates rise, the value of fixed-rate assets such as mortgages or bonds can decline, leading to a mismatch between banks' assets and liabilities. This can reduce their net interest margin and profitability. In the 2008 financial crisis, the Federal Reserve allowed banks to invest in 0% Treasury bonds. Why is this no longer a viable option for the banking industry in the current scenario? During the 2008 financial crisis, the Federal Reserve implemented a policy of quantitative easing, which involved buying large quantities of government bonds and other securities to inject liquidity into the financial system and lower interest rates. As part of this policy, the Fed also implemented a zero interest rate policy, which meant that banks could borrow money from the Fed at very low rates and invest in government bonds with minimal risk. In the current scenario, interest rates have been low for an extended period, but the Fed is now starting to raise rates, making it less attractive for banks to invest in low-yielding government bonds. With the possibility of rising interest rates, banks may face potential losses if they invest in long-term bonds with fixed rates. Therefore, the option to invest in 0% Treasury bonds may not be as useful for banks as it was during the financial crisis. Moreover, the current economic situation is different from the 2008 financial crisis, as the current situation is caused by a pandemic-induced recession. The pandemic has had a severe impact on the economy, causing job losses and business closures. In response, the Fed has implemented monetary policy measures to support the economy, such as providing liquidity to financial markets, lowering interest rates, and buying government and corporate bonds. However, the economic recovery has been slow, and there is still uncertainty about the future trajectory of the pandemic and the economy. In summary, while the option to invest in 0% Treasury bonds was useful for banks during the financial crisis, the current scenario is different, and the benefits of such an option may not be as significant. With the potential for rising interest rates, banks may need to adjust their investment strategies to adapt to the changing economic conditions. What are the differences between the pros and cons of the Federal Reserve's policy of quantitative easing and zero interest rate policy during the 2008 financial crisis and the current crisis? Pros and cons of the Fed's policy of quantitative easing and zero interest rate policy, ZIRP, during the 2008 financial crisis. Pros: increased liquidity. The Fed's policy of quantitative easing helped inject liquidity into the financial system by buying large quantities of government bonds and other securities. This helped ease credit conditions, making it easier for businesses and individuals to borrow money and support economic activity. Lowered borrowing costs. The ZIRP policy meant that banks could borrow money from the Fed at very low rates and invest in government bonds with minimal risk. This helped lower borrowing costs for businesses and consumers, making it easier for them to access credit and support economic growth. Boosted asset prices. The Fed's policy of buying government and other securities helped boost asset prices, including stocks and bonds, which helped improve investor confidence and support economic growth. Cons: reduced interest income for savers. The ZIRP policy meant that banks offered very low interest rates on savings accounts and other deposit products, reducing interest income for savers and retirees who rely on interest income to support their living expenses. Increased risk-taking. The low interest rates encouraged investors to take on riskier investments to achieve higher returns, potentially leading to asset bubbles and increased systemic risk in the financial system. Potential for inflation. The massive injection of liquidity and low interest rate environment created by the Fed's policies could lead to inflation if the economy overheats, potentially eroding the value of savings and investments. Unequal distribution of wealth. The Fed's policies of boosting asset prices and lowering borrowing costs benefited wealthy investors and businesses more than lower-income households, potentially exacerbating income and wealth inequality. In summary, while the Fed's policy of quantitative easing and ZIRP during the 2008 financial crisis helped support economic growth and prevent a deeper recession, it also had some negative consequences, such as reduced interest income for savers and increased risk-taking in financial markets. Pros and cons of the Fed's policy of quantitative easing and raising interest rates during the current financial crisis since 2022. In the current scenario, where interest rates are still low but starting to rise, banks are facing some unique challenges. Here are some potential pros and cons of rising interest rates for banks. Pros: increased net interest income. As interest rates rise, banks can charge higher interest rates on loans while paying out relatively lower interest rates on deposits. This can increase the spread between the interest earned and the interest paid, leading to increased net interest income and profitability for banks. Improved asset quality. As interest rates rise, borrowers may be more likely to repay their loans, reducing the risk of loan defaults and improving the quality of banks' loan portfolios. Increased demand for deposit products. As interest rates rise, savers may be more likely to deposit money into savings accounts and other deposit products, potentially increasing banks' deposit base and liquidity. Cons: reduced demand for loans. As interest rates rise, borrowers may be less likely to take out loans, as the cost of borrowing becomes more expensive. This can lead to reduced demand for loans and potentially lower loan volumes for banks. Increased funding costs. As interest rates rise, the cost of funding for banks may also increase, as they may need to pay higher interest rates to attract deposits and other forms of funding. Potential for asset price declines. rising interest rates can also lead to declines in asset prices, including real estate and stocks, which can negatively impact banks' balance sheets and profitability. Risk of interest rate mismatch. Banks may face a risk of interest rate mismatch if they have more long-term assets, such as mortgages or fixed-rate loans, than short-term liabilities, such as deposits. If interest rates rise quickly, this could lead to losses for banks with a large interest rate mismatch. In summary, rising interest rates can have both pros and cons for banks. While banks may benefit from increased net interest income and improved asset quality, they also face potential challenges such as reduced demand for loans and increased funding costs. Banks will need to carefully manage their balance sheets and adjust their strategies to adapt to the changing interest rate environment. How does the current state of the banking industry affect the real estate mortgage industry? Rising interest rates can have a significant impact on the real estate mortgage industry, as higher rates can affect both mortgage borrowers and lenders. Here are some potential impacts. Reduced affordability for borrowers. Rising interest rates can make mortgages more expensive for borrowers, reducing their purchasing power and potentially reducing demand for homes. This can lead to a slowdown in the real estate market and potentially lower property values. Reduced demand for refinancing. As interest rates rise, fewer borrowers may be eligible or interested in refinancing their mortgages, reducing demand for refinancing services from lenders. Reduced profits for mortgage lenders. Rising interest rates can reduce demand for mortgages, potentially reducing the volume of loans originated by mortgage lenders. This can lead to lower profits for lenders and potential layoffs or other cost-cutting measures. Increased competition among lenders. As the volume of mortgage originations declines, mortgage lenders may face increased competition for a smaller pool of borrowers. This can lead to increased marketing and advertising costs for lenders and potentially lower profit margins. Increased risk of loan defaults. Rising interest rates can increase the risk of loan defaults, as borrowers with adjustable rate mortgages or variable interest rates may struggle to keep up with higher mortgage payments. This can lead to increased foreclosures and potentially lower property values in certain regions. In summary, rising interest rates can have a significant impact on the real estate mortgage industry, potentially reducing affordability for borrowers, reducing demand for mortgages and refinancing, and reducing profits for mortgage lenders. Mortgage industry participants will need to carefully manage their strategies and operations to adapt to the changing interest rate environment. If banks raise interest rates and are unable to offer good returns to their clients, how could this impact the bank's financial stability, including potential bankruptcy and loss of deposits? If interest rates rise and banks are not able to offer competitive rates to their depositors, customers may withdraw their deposits and seek higher returns elsewhere, which could lead to a decline in the bank's deposit base. This could make it more difficult for the bank to fund its operations and lend money, potentially leading to a decline in profitability. In extreme cases, if a bank is unable to attract new deposits or raise capital from other sources, it may face a liquidity crisis and potentially become insolvent. However, it's important to note that bank failures due to rising interest rates are relatively rare, as banks are generally able to adjust their deposit rates and other strategies to adapt to changing interest rate environments. To mitigate these risks, banks may take several steps, such as adjusting deposit rates. Banks may need to adjust their deposit rates to remain competitive and retain their deposit base. This may involve raising interest rates on certain deposit products or introducing new deposit products with higher rates. Managing their loan portfolios. Banks may need to carefully manage their loan portfolios to reduce the risk of loan defaults and other credit risks that could impact their profitability. Diversifying their funding sources. Banks may need to diversify their funding sources to reduce their reliance on deposits and other traditional sources of funding. This may involve raising capital through equity or debt issuances or seeking alternative sources of funding such as securitization. Adapting their business strategies. Banks may need to adapt their business strategies to the changing interest rate environment, potentially focusing on certain types of lending or deposit products that are less sensitive to interest rate fluctuations. In summary, rising interest rates can pose risks to banks' profitability and liquidity, but banks have a range of strategies at their disposal to mitigate these risks and adapt to changing interest rate environments. If clients withdraw more than 50% of their deposits due to low interest rates, how could this affect the stability of a bank? If a significant number of clients remove 50% or more of their deposits due to less interest being paid to clients, it can have a significant impact on the bank's liquidity and ability to fund its operations and lend money. When customers withdraw their deposits, the bank's deposit base decreases, which can make it more difficult for the bank to fund its operations and lend money. If the bank is unable to attract new deposits or raise capital from other sources, it may face a liquidity crisis and potentially become insolvent. To avoid this scenario, the bank may need to take several actions, such as adjust deposit rates. The bank may need to adjust its deposit rates to remain competitive and retain its deposit base. This may involve offering higher interest rates on certain deposit products or introducing new deposit products with higher rates. Increase marketing efforts. The bank may need to increase its marketing efforts to attract new customers and deposits to replace those that have been withdrawn. Reduce expenses. The bank may need to reduce its expenses to improve its profitability and preserve its capital base. This may involve cutting costs such as salaries, rent, and other operational expenses. Sell assets. The bank may need to sell assets to raise capital and improve its liquidity. This may involve selling loans or other securities to other financial institutions or investors. In summary, if a significant number of customers withdraw their deposits from a bank due to lower interest rates, it can have a significant impact on the bank's liquidity and ability to operate. The bank may need to take several actions to address this situation, including adjusting deposit rates, increasing marketing efforts, reducing expenses, and selling assets to raise capital. Given the current inflation and rising interest rates, what could happen if banks are unable to sell their assets, reduce expenses, or alter their deposit rates? If a bank is not able to sell its assets, reduce expenses, or alter its deposit rates, it may face a liquidity crisis and potentially become insolvent. Inflation and rising interest rates can have a significant impact on a bank's profitability and liquidity. If interest rates rise, the bank may need to pay higher interest rates on its borrowings, while also facing a decline in the value of its assets. This can lead to a decline in profitability, which may make it more difficult for the bank to fund its operations and lend money. If the bank is not able to sell its assets, reduce expenses, or alter its deposit rates, it may be unable to generate the cash flows it needs to meet its obligations, such as paying depositors and other creditors. This can lead to a liquidity crisis, where the bank is unable to meet its short-term obligations. In this scenario, the bank may need to take several actions to address its liquidity issues, such as seeking emergency funding. When a bank faces a liquidity crisis, it may seek emergency funding from other financial institutions, the government, or other sources to meet its short-term obligations. Emergency funding may come in the form of loans, lines of credit, or other types of financing. However, emergency funding often comes with high interest rates and may require the bank to pledge collateral, such as its assets, to secure the funding. Liquidating assets. If a bank is not able to sell its assets, it may need to liquidate them to generate cash and improve its liquidity. Liquidating assets involves selling them in the market to raise cash. However, selling assets in a hurry may result in losses or lower prices, which may negatively impact the bank's profitability and financial position. Seeking a merger or acquisition. A bank may seek a merger or acquisition with another financial institution to improve its financial position and increase its liquidity. Merging with or acquiring another bank can provide access to additional capital, funding, and customer deposits. However, mergers and acquisitions can also be complex and may require regulatory approval. Filing for bankruptcy. In extreme cases, a bank may need to file for bankruptcy if it is unable to address its liquidity issues through other means. Bankruptcy involves liquidating the bank's assets to pay off its creditors. While bankruptcy can help the bank avoid a complete collapse, it can also lead to significant losses for depositors, shareholders, and other stakeholders. In summary, a bank facing a liquidity crisis may need to take several actions to address its situation, including seeking emergency funding, liquidating assets, seeking a merger or acquisition, or filing for bankruptcy. Each of these actions has its advantages and disadvantages, and the bank will need to carefully consider its options to determine the best course of action. What are some alternative investment options available to bank clients if their bank is not providing competitive interest rates? Money market funds. Money market funds are mutual funds that invest in short-term, low-risk securities, such as treasury bills, commercial paper, and certificates of deposit. These funds typically offer higher yields than traditional savings accounts or CDs and can be a good option for clients looking for a low-risk investment with a higher return. High-yield savings accounts. Some online banks and financial institutions offer high-yield savings accounts that offer better interest rates than traditional savings accounts. These accounts may require a minimum deposit or balance and may have limited access to funds. Certificates of deposit, CDs. CDs are low-risk investments that offer fixed interest rates for a specified period, ranging from a few months to several years. CDs typically offer higher interest rates than traditional savings accounts, but the funds are locked in for the duration of the CD term. Corporate bonds. Corporate bonds are debt securities issued by companies to raise capital. Investors purchase these bonds, which are backed by the issuing company's ability to repay the debt and receive periodic interest payments until the bond matures. Corporate bonds can offer higher yields than government bonds or savings accounts, but they also carry a higher risk of default. Real estate investments. Real estate investments, such as rental properties, can provide a steady stream of income and long-term capital appreciation. However, real estate investments can be risky and require significant upfront investment. Cryptocurrencies. Cryptocurrencies are decentralized digital assets that use cryptography for security and operate independently of central banks. The value of cryptocurrencies can be volatile, and their regulatory environment is still evolving. Investing in cryptocurrencies can provide the potential for high returns, but it also carries a high level of risk due to the volatility of the market. What is the average return on investment for the various investment options available, such as stocks, bonds, mutual funds, money market funds, high-yield savings accounts, CDs, corporate bonds, and real estate investments? Money market funds. The average return for money market funds since 2000 has been around 1.53% per year. High-yield savings accounts. The average return for high-yield savings accounts since 2000 has been around 2.34% per year. Certificates of deposit, CDs. The average return for CDs since 2000 has varied based on the duration of the CD and market conditions. For example, a 1-year CD may have an average return of around 1.81%, while a 5-year CD may have an average return of around 2.60%. Corporate bonds. The average return for investment-grade corporate bonds since 2000 has been around 4.63% per year. Real estate investments. The average return for real estate investments since 2000 can vary widely based on the type of investment and location. For example, the NCREIF Property Index, which measures the performance of private commercial real estate in the U.S., had an average annual return of around 6.96% from 2000 to 2020. Cryptocurrencies. Cryptocurrencies have a relatively short history, with Bitcoin being introduced in 2009. Since its inception, Bitcoin has had an average annual return of around 200% per year. However, it is important to note that the cryptocurrency market is highly volatile, and past performance is not a guarantee of future results. It's essential to note that these average returns are based on historical performance and do not guarantee future returns. Investing involves risks, and market conditions, economic factors, and other variables can significantly impact investment returns. It is essential to conduct thorough research and seek advice from a financial advisor before making any investment decisions. If a client's investment exceeds $250,000 and is not insured by the FDIC, what happens to their funds in the event of a bank failure? If a client's investment in a bank is more than $250,000 and not insured by FDIC, there is a risk that their funds may not be fully protected in the event of a bank failure or bankruptcy. The FDIC provides insurance coverage of up to $250,000 per depositor, per insured bank, for each account ownership category. If a client has more than $250,000 in a single account, they can consider spreading their funds across multiple banks or account ownership categories to ensure that all of their funds are fully insured. Alternatively, they can consider investing in other types of assets, such as those mentioned earlier, that offer a potentially higher return but also carry a higher level of risk. It is important for clients to carefully assess their risk tolerance and consult with a financial advisor before making any investment decisions. What steps can clients take to secure their investments in a bank if their funds exceed $250,000? Open accounts at multiple banks. By spreading their funds across different banks, a client can ensure that each account is insured up to $250,000 by the FDIC. This is a simple way to increase protection for their deposits. Use different ownership categories. The FDIC insures deposits in different ownership categories separately. For example, a client can have $250,000 in an individual account and $250,000 in a joint account at the same bank, and both accounts will be insured up to $250,000 separately.
By using different ownership categories, a client can increase the amount of FDIC insurance coverage for their deposits. Use CDARS. CDARS, Certificate of Deposit Account Registry Service, is a program that allows clients to spread their deposits across multiple banks while only dealing with one bank. The program automatically distributes funds among participating banks to ensure that each deposit is insured up to $250,000. It's important to note that investing in securities such as stocks, bonds, and mutual funds is not insured by the FDIC and carries a different set of risks. Clients should always consult with a financial advisor before making any investment decisions. Keep watching the videos to keep yourself updated on the current circumstances.